Morning, guys. This is really cold. I filmed that intro like 2 hours ago. Today we're talking about something really important that a lot of people use but don't really know how it works. They just kind of use it and go along with the flow, not really questioning what's happening. And we're talking about credit cards. So, credit cards allow you to make purchases and not have to pay, right? Well, sort of. Really what happens is that you charge the payment to your card, and then the institution that's funding the card, usually a bank, in my case it would be Chase, they pay the merchant what you owed them. Chase takes the money out of their account and gives it to the merchant. And then in exchange for that, they credit your account. So now you have an account, usually online, and it says you owe this much money. And the good thing about credit cards is that usually you don't have to pay that money until the end of the month. So if you only get paid once a month or twice a month, you can wait until your payments come in and then make those payments. But if you've ever tried to get a credit card, you know about this one thing called the credit score. Basically, this credit score decides how credit worthy you are, how much you can be trusted with a certain amount of money, and how much the bank trusts that you will pay them back in a timely manner. This credit score is very important. In this video, we're going to talk about what the credit score is used for, how they calculate it, and how you can get a higher credit score. I'll be throwing in some tips and tricks and a little bit of math in the way, and hopefully you guys will learn how to properly manage and use your credit. The first thing I have to say about credit cards is that they're a very useful tool, but they should also be used with extreme caution. This is because credit cards have an option for you to make a minimum monthly payment at the end of the month. Usually, if you owe around $5,000, this minimum payment will be about $100. And you're like, wow, that's a steal. I can buy $5,000 worth of stuff and only have to pay $100. While this is true, there's also something deeper happening in the background. That $4,900 that you did not pay off on your minimum payment suddenly starts accruing interest. And usually with credit cards, especially if you have lower credit, this interest can be up to 20% a year. That's insane, that's massive. You never want to pay 20% interest on any debt or loan you can ever take out. Usually banks will give you loans, depending on what it is, from anywhere between 2% to 8%. Paying more than double that is absolutely ludicrous. So please, if you take money out on a credit card, always pay it off in full at the end of every single month. That's the disclaimer. Now we can get into it. It's really important that you guys keep that in mind. Always pay off your credit cards. Always pay off your credit cards. Okay, we covered it a little bit, but why is credit score useful? The first reason credit score is useful is because in order to get a credit card, you need a credit score, which sounds like a cyclical kind of trap. Later on in the video, we'll get into how to start that cycle and how you can get started on your credit. But for now, let's just say you have very low credit. Your bank is not going to give you a high credit limit if you don't have a high credit score. So if you have a credit score of around 600, they might only give you $1,000 or even less than that. But once you start getting up into the 700s and the 800s, they're likely to increase that score to $5,000, $10,000 based on how much money you make annually. The second one is that if you ever need to take out a loan or a mortgage, a high credit score will keep your interest rate on that loan very low. So I did some quick math here, and this is how it works out. So let's say you have a very low credit score, let's just say around 650, and the bank that's lending you the loan only allows you to take out a loan at 7%. So let's say you took out a loan for $10,000 over a 5-year period. At 7% interest, you would be paying $198 a month for the whole loan, equaling up to $1,880 in total interest paid over the lifetime of that loan. Now, if you had a higher credit score, let's say 740 to 750, that's usually considered about the upper range of good credit. Any more than that, you get very diminishing returns. But let's just say you are in the upper range, you could get a loan for 3%. That 3% loan in exchange, you'd only have to pay $179 a month for, and you'd only end up paying $781 in total interest over the period of that loan. So having a high credit score just saved you around $1,000. Third, and probably most important if you're watching this video right now, it's one of the major factors that landlords look at when they decide whether or not they want to rent out to you. If you have a low credit score, landlords might not think that you'll be able to pay in time, and in exchange, won't let you rent out their property in fear that you might not pay. Even if they do let you rent out the property, then maybe they'll have to charge you double the security deposit, or maybe they'll have to increase the rent a little bit just to cover the fact that you're more of a risk to rent to. So these are 3 really main big reasons on why you want a good credit score. You can get more purchasing power with your credit card, you can get cheaper loans, and you can find nicer places to rent out and rent for less once you have a good credit score. All right, on to section 2, how this credit score is calculated. So we're gonna go over to my laptop and we're gonna take a look at a nice website. Okay, so here we have mint.com. Now, mint.com is a really good website because it allows you to keep track of your spending, but it also has a really handy tool that allows you to look at your credit score. And we're looking at my credit score right now. It's pretty decent. It's gone down over time a little bit, and we'll discuss why. The first section here is one of the ones that's really important. It's your on-time payments. So on-time payments make up 35% of your total credit score. On-time payments basically just means that every single month you pay your credit on time, whether that be the minimum amount or the full payment. As we've discussed, it always should be the full payment, but if you can't make it, at least pay the minimum, because that way your credit score won't be hit. Now, the second highest category is your credit usage, and this makes up for about 30% of the score. Your credit usage is basically how much of your credit you use based on your maximum limit. If your bank has given you $5,000 in total credit and you use $3,000 of it, you've used 60% of your credit. Now, that's a little bit high. Usually you want to aim for about 30% of credit usage. Anything higher than that, it'll start to lower your credit score. And this is because banks start to see you as a risk because you're approaching your limit faster and faster. A good way to keep this down is to pay off your credit card twice a month as opposed to once a month. That way your limit will on average be lower. Now here we're gonna take a look at some of the poor scores of my credit, or poor side of my credit score. That's being your average age of your credit. So average age of credit is about 15% of the credit score. Not too high impact, but still important. Usually you wanna aim for around 3 to 4 years of credit history. Now, obviously, that's not something you can control, but this is when it'll start to turn green and be kind of an addition to your credit score as opposed to a hindrance to your credit score. Now, a good way to keep this high is to make sure that any long-lasting accounts that you do have don't get closed. So if for some reason your credit score plummets out of nowhere, check to make sure that none of your accounts have been closed due to inactivity. Now, number 4 is a credit mix. So on the official FICO page, they say a mix of credit, but here they say your total accounts. They're kind of simplifying it on this webpage, but it's really the amount of mixed assets that you have. So if you have a couple of credit cards, that's good, and especially if you pay them off, that's great. But the banks don't know how well you handle loans or how well you handle mortgages. So really what you want to do is you want to take out as many different possible lines of credit that is safe to take out, and that'll boost your score. That being said, this is only 10% of the score, so don't ever overextend yourself just to get a better mix. But ideally you would have a credit card, a loan, and then some kind of mortgage. All right, and the last 10% is credit inquiries. So credit inquiries are basically whenever you take out a credit card, the company has to go to a credit agency and ask them what your credit score is, basically to take out a credit report. This dings your score a little bit. So usually 2 or 3 aren't bad, but anything over 3 credit inquiries within a 6-month period signals to banks that for some reason you're out there trying to get as many lines of credit as possible, and you might be a risk because usually people don't take out 5 new lines of credit in 6 months. So you want to maybe take out a new credit card every 1 or 2 years. If you need to, maybe 2 per year is fine, but try not to overextend it past that. So this whole credit mix kind of takes care of how it's made. And then we're gonna go back to me on the camera. Now you know what credit is used for and how it's calculated. So all of these percentages get thrown into something called the FICO score, which is a normalized way of calculating credit. And basically, credit agencies like Equifax or TransUnion take this FICO score, put in information to it, and they get a number out. So sometimes you'll be looking at your credit score and you'll see that it's a little bit different from Equifax or TransUnion. And the reason for that is because they both have different information on you, and that different information can lead to slightly different scores over time. But one really important thing to make sure is that when you're checking your credit score on Equifax or TransUnion or Credit Karma, which is also a very good website, it's free, you should check it out. It gives you all your credit score history. Make sure that there's nothing wrong, because these agencies sometimes do get it wrong, and that impacts your score. So if you're looking at your scores and you see that one agency is rating you significantly lower, like 30 or 40 points lower than another, go into the history and make sure that they don't have any wrong accounts or wrong missed payments that you actually did pay, because that can really put a bummer on your credit score without proper reason. Now we know why it's a good reason to have a good credit score and how it's calculated, and now we should get into like the real stuff, how to actually get and start using credit. I think one of the best ways to start is by getting a secured credit card. A secured credit card is a credit card that a bank gives you, but the difference is that when you go to take out this credit card, you give the bank the money that they're going to lend to you, which is kind of counterintuitive, but it does two things. First, it guarantees the bank that they won't lose any money by giving you this credit card. You're going to give them $200, and they're going to give you a $200 credit limit. If you use the whole entire limit and never pay it back, they could care less. You've already paid them for the limit. And second, it allows you an opportunity as someone with either bad credit or no credit to get into the credit game. If you give them this $200 and take out that line of credit and use it once a month for something silly like some bubble gum or maybe some movie tickets, and you pay it off on time every time for 6 months, suddenly you'll have a credit history, and a very good one at that. So you should have a credit score somewhere between 650 to 700 if you do that. And then at the end of this, they'll say, okay, you've made all your payments, you've done good on your credit, here's your $200 back, plus here's another $300 of credit limit, because we've seen that you're now a trusty borrower. So now you have $500 in credit limit, and you get your $200 back. So this example that I'm using is the Citi MasterCard. So the Citi MasterCard is super good because it only requires $200 down payment, which sounds like a lot, but when compared to other cards that require $500 or even $1,000, it's a pretty good deal. On top of that, the Citi Master Secured card does not require an annual fee, which a lot of them do. The only downside to this card is that it still does need a credit check. So if you have bad credit, then you might get declined for this card. That being said, it is still a credit card. So the important rule that I said in the beginning still applies now. Even though you paid them the $200, they're still going to charge you interest on the money you have outstanding. So always pay your credit at the end of the month in full. It'll save you a lot of money in the long run. Okay guys, so these are my tips for building credit, for what credit is and for how to calculate your credit. And I hope this really helped you guys. If you have any questions about credit or what credit card you should get, message me down below in the comments. If you guys want to see more videos on credit, like what kind of credit cards you should get, which ones are the best, how to get credit points, credit card churning, there's a lot of things that I could cover. If you're interested in seeing any of that, leave it down in the comments. And as always, like, subscribe, hit the bell icon, and have a great day.